Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we have Bob Phillips with us, and we are excited to talk with Bob, and we are going to hear some of his story, his background, and his 47-year career in oil and gas. And a lot of our listeners will know Bob sold Crestwood Equity Partners to Energy Transfer here in the last year. And so we're excited to talk a little bit about that transaction, but we want to really get the entire story. What happened before Crestwood, during Crestwood's build, and since that incredible sell to Energy Transfer. First of all, Bob, welcome to the podcast. We're so grateful to have you. Would love to hear just a brief overview of your life and family and stuff like that.
Well, thanks, Justin. Good morning to you and all your listeners. Great opportunity for me, and I appreciate the connection that we made through an old friend of mine that we worked together back in the 70s. Really at the beginning of what we call the era of natural gas deregulation. So I go back a long way and have seen many cycles in the oil and gas industry, a lot of changes in the way the industry is run and the approach to trying to meet the needs of the public, both in the U.S. as well as around the world, to provide reliable, cheap energy to keep the economy going. So I'm proud of the fact that I've been a career midstreamer from the very beginning, all the way through the 47th year. And as you said, the sale of my last company, Crestwood Equity Partners, a publicly traded master limited partnership, to the largest MLP in the business, Energy Transfer, headquartered in Dallas, company that we have a lot of respect for as they've built an extraordinary diversified portfolio of midstream assets in all of the major energy categories: oil and gas and refined products and natural gas liquids. So really proud to have completed that transaction in November of last year, and proud to be an Energy Transfer shareholder. And I would encourage all of your listeners to take a look at the midstream space. There are a number of great companies in oil and gas midstream, and we provide essential services primarily in the building and operation of midstream infrastructure necessary to get oil and gas from the wellhead to the burner tip, or, now we say the wellhead to the water, because exports are such an important part of our industry and the demand for the product that we develop and generate here in the U.S. So I guess your question was go back to the beginning and give you a little bit of sense for where I came from and how all this happened over time, and maybe have an opportunity to throw out some pearls of wisdom as we go along, particularly for the younger folks that are either just getting started or in their second or third career change in oil and gas, and how important certain things were to me and my family and my success, and how important they will be to others in similar situations. So just at the very beginning, I was raised in Tyler, Texas, good old East Texas boy. I was a cowboy, played football, baseball, the local high school. Really enjoyed growing up in small town America. Tyler was a town of about 50,000 people at the time I grew up in the 60s and 70s. Conservative, largely Baptist, no alcohol. You had to go to the next county just to buy a beer. My dad was a state district court judge, so I grew up in a law enforcement, conservative Republican family, and I really appreciate the lessons that my mom and dad taught us, and that was hard work and integrity and going to church and being a good citizen and a good contributor to the community, particularly when you had many blessings as we did growing up. So I enjoyed Tyler. Went on to the University of Texas, 72 to 70, 74 to 77. Got in an oil and gas program. Interesting story about how that happened. We had a parents' weekend, big football game. We had a party at our apartment after the game. One of my roommates from Corpus Christi, whose dad ran an oil and gas company back in the 70s. This was all pre-shale, so it was a totally different business back then. Invited a guest who was his petroleum engineer on staff. He buttonholed me during the party and said, "Have you ever thought about going to South Texas to work on a drilling rig?" And I said, "Well, no, I don't know anything about that." And he said, "Well, it's a great industry. And if you're interested in making a lot of money, then come on down to Corpus Christi when the school's out, and I'll get you a job in South Texas on a drilling rig," which I did.
Wow.
And it might get a chuckle out of you and everybody else, but I made $2.15 an hour as a
Wow.
rig hand. That was the going wage. And if you worked a double tower or a double shift, 8 hours the first shift, 8 hours the second shift, you got paid time and a half. So I made like $3.65 for that second shift. Made enough money during the
Incredible.
summertime working on a drilling rig in South Texas, living in a old beat up motel for $20 a week in Alice, Texas. But I fell in love with the oil and gas industry. It was romantic, it was industrial, it was essential to America, it was patriotic, it was all the things that I could think of in a career. My dad, of course, having been lifetime lawyer and state district court judge, wanted me to go to law school, be a lawyer, come back to Tyler, practice law with him. And that was a great idea. But after a couple of summers of working on a drilling rig, I just fell in love with oil and gas. And so, very lucky when I graduated UT in 1977 with a petroleum land management degree, got a job with Gulf Oil Company. That was one of the Seven Sisters, long before it was merged with Chevron, now part of Chevron. And I just fell in love with oil and gas. I moved to Houston. I'd never been to the big city before other than to go to an Astros game. Didn't really know anything about it. I was the proverbial country dog in the big city, trying to make sure that I didn't get run over by a big bus. And that was the beginning of my career. 4 years and a few different jobs, Gulf for a year and a half, company, very small back then called Anadarko, now a big company and part of Oxy
Wow.
50 years later, for about a year. And then I went to work for Tenneco. And I shifted from working for a producer to working for a natural gas pipeline. Tennessee Gas Pipeline was the largest pipeline in America at that point in time. We gathered gas in South Texas and offshore Louisiana and took it all the way to Boston and the East Coast for those customers, those utilities and power plants that use natural gas. So in the early days, I had a great introduction to all different sides of the oil and gas industry, and that gave me not only context for what I wanted to do later in life, but I think it built a great level of understanding of how important the industry was, both from a producing standpoint, exploration, production, drilling, services, all the things that it took to go drill a well, complete a well, and then get it on production, and then take that production all the way to market, and how important the market was for that. I'll pause a little bit. That's kind of the background before I got into the I guess the more important building blocks of my career, because the next step for me was to go out on my own and start my first company.
That's incredible. Appreciate you sharing that. I am fascinated. We just talked with Terry Nixon recently on the podcast, and it seems like the 1970s at Tennessee Gas. Who could have ever imagined what would come from that? And the group of you all that were at that company and what you eventually built is just incredible.
Well, we had not only high profile jobs, we were charged with buying natural gas and putting it into the pipeline to ship it all the way to Boston, New York City and Boston, at a time in which production was falling off pretty dramatically. This
Wow.
was pre-shale. This was pre-Natural Gas Policy Act, which for the first time Congress created incentive pricing for natural gas producers because, frankly, we were running out. And I recall 1977, the year I graduated from college, Jimmy Carter was president. A guy named Schlesinger was Secretary of the Energy. And the National Petroleum Council did a year-long study and determined that we were running out of natural gas reserves. We only had 20 years left. This was in 1977. We were producing as a country about 25 BCF a day. Here we are 50 years later, and we're producing 105 BCF a day, 4 times the amount back then, all attributed to enormous natural gas resources and reserves around the country and the tremendous technological changes that have taken place over the last several decades to bring more oil and gas production out of the ground on a very safe and efficient basis. So I was at the very beginning of the deregulation phase for natural gas. Over the next 10 years or so, we had deregulation. We had natural gas marketing and trading companies that were started up. We had open access transportation. And ultimately, we developed a much broader market for natural gas, which led to higher prices, which then incentivized producers to drill deeper, to begin to test horizontal drilling and fracture stimulation back in the late 70s, early 80s, that didn't become prevalent in the industry until George Mitchell in the late 80s, early 90s, developed what is now known as the Barnett Shale, which actually didn't become a major gas producing basin around the Dallas-Fort Worth area until 2007 and 8. So this was 20 years before horizontal drilling, fracture stimulation. Everything was vertical well drilled. Wells would oftentimes be completed, fracked, and would only produce for 3, 4, 5 years. Today, wells produce for 30 or 40 years because of the technology that we've developed as an industry. So we got to see a lot of change through the deregulation of the natural gas industry and ultimately the deregulation of the oil industry as well. One of the more important things that happened early on post-shale is the federal government decided to lift the restrictions on exports of oil and gas, which led to now we produce 13.5 million barrels of oil per day in the U.S., but we export 4 million barrels a day to our allies and our friend countries, trading partners around the world. That's an essential component to the success of the oil and gas industry. And on the natural gas side, I think you all are aware of how important LNG exports are and exports to Mexico. We now export over 20 BCF a day, 20% of total U.S. production of over 100 BCF a day. And the natural gas exports, again, are not only important for the economics of our industry, but the geopolitical benefits that come from being able to export natural gas to our friends in Europe so that they can get off of Russian exports. But we watched all that unfold at Tenneco back in the 70s and 80s. I was very blessed. We all were blessed to have great mentors, older gentlemen who had been in the business dating all the way back to the 50s and the origin of the modern oil and gas industry as we know it today. And so we learned a lot from mentorship. And many of us have stayed together, stayed friends for over 50 years. And out of that group, there's a surprising number of very successful men in this business.
Absolutely. Yeah, the story of natural gas over the last 50 years is incredible. And it's just critical that it's been able to grow and sustain and provide energy domestically and abroad. Bob, I am interested. We're going to get into some of the details of Crestwood and your career. But I am interested to hear, what was your first memory of money growing up?
Well, I left out an important step, recalling that my dad was a district court judge. He wanted me to go to law school. I wanted to go to work in the oil and gas industry. So we made a deal, a bet, if you will, that I would get a job and work in the industry during the day, and I would go to night law school, which I did for 3.5 years while I was married with my first child. That was a
Wow.
long 3.5 years of night school. But the bet was that when I graduated law school in 1981, if I was making more money in the oil and gas industry than were first year law school graduates, then he would be fine with me staying in the industry. But he always assumed that I was going to break my pick somewhere along the way and that I would ultimately fall back on my law degree and come to Tyler and practice law with him. Well, I never did. That first job was a little bit better than making $2.15 an hour. I remember my first paycheck from Gulf Oil Company was $1,200 a month, or about $900 after taxes. And that
Wow.
was more money than I had ever known in my life, other than my summertime job of working on a drilling rig, which all of that money went for paying for the next year's tuition at UT. So $1,200 a month is where I started. I'll never forget the first time that I got Gulf stock as part of my year-end bonus. I got four shares of Gulf stock worth $32 each,
Wow.
$125 total value. But more importantly, I got a stock certificate, and I had never seen a stock certificate before. I
Yeah.
was raised in an all cash family. My dad didn't use credit cards. He didn't make an investments. He didn't read the Wall Street Journal. He had a checking account and a savings account, paid a mortgage just like everybody else. So in my early days, I came to appreciate the value of money and how important it was to make money and save money. I had this conversation with one of my kids the other day. I said to him, I probably still have the first dollar I ever put into a 401k. Um,
Wow.
and so it just shows you the value of saving and making room in your family portfolio or your spending portfolio to start putting money away. The compounding effect that you guys as financial advisors preach to your clients is really true. And when I look back over my 47-year career and I think about how I've saved every month some part of my paycheck to go into that account, it wouldn't surprise you. It's a pretty large 401k amount. And I could probably live on that the rest of my life. I'm glad I don't have to depend upon the measly $4,700 a month I'll get from Social Security starting in a couple of months when I turn 70. So I was one of those guys that took seriously the importance of retirement investing in retirement accounts and putting money away and manage your spending appropriately. But we came from very modest backgrounds, so $1,200 a month and 900 net after taxes was more money than I'd ever had before. And so when we first got married in 1979, Shirley was a school teacher making $800 a month. I made $1,200 a month. Between the two of us, we made $2,000 a month, and we were rich. We
That's
were
incredible.
rich.
Some of our listeners will know this. I've talked about this off and on, but my wife Lauren just graduated from the Texas A&M School of Law, and so kind of a similar path where we have three kids, and they are now 10, 8, and 6. And so she just finished 3 years of law school with three kids. So I can kind of resonate with you about how difficult it is to work and go to law school with children. Was there ever a point in law school where you thought that you may pursue a law career instead of oil and gas, or did you always know that it would lead back to oil and gas?
I always knew. I viewed the law degree as a great backup, but more importantly, it gave me exposure to areas of the law that would be incredibly important to the rest of my career. And I've always said what law school taught me was when to hire a good lawyer. And throughout my entire business career, uh, having started my first public company in my first company in 1981 at the age of 26, the year that I graduated law school, and taking it public in my first IPO in 1987, I essentially practice law every day as a CEO of a publicly traded company, whether it's understanding securities regulations or the importance of investments, governance, regulatory impact on the industry. Our business, as you know, has been highly regulated, as your industry is. Being an FA, you know how important regulatory compliance is. And so my law degree gave me great education, information, perspective about that. But of course, I always had it as a fallback. But I never wanted to practice law, so it made me work even harder to not have to call my dad up and admit that I had failed in oil and gas. So again, the law degree was a critical part of making me, I think, the executive that I have been over the years, understanding the importance of compliance and understanding, contracts. I think my two favorite courses really had nothing to do with one another. One was contracts. It was the very first course that I took in law school in the summer of '77, and I practiced contract law, negotiating oil and gas contracts, buying and selling gas, building plants, building pipelines, entering into long-term contracts with customers to deliver product to them. My start for all of that was a contracts course in the summer of '77 and
Wow.
understanding contractual relationship between people and how important it was to meet your contract obligations. And so I'm proud to say that I've had very, very little litigation in my career, both on the plaintiff as well as the defense side. So, and that comes from always setting the tone in the companies that I work for or that I started and led as a CEO, the importance of contract compliance, regulatory compliance. I learned that skill set in law school during that 3.5 years.
That's incredible. And that makes a lot of sense. Bob, you went through your first IPO at age 32. I think you mentioned it was 1987. What do you think made you, instead of taking kind of a safer career track, always working at a major, super major, or in law, what made you kind of forego safer career tracks to instead take executive roles, own your own companies, and much more entrepreneurial risk? What led you down that path?
It's really an easy answer. It's not a series of accidents as a lot of things later in my career played out almost on an accidental basis. As I look back on those first few years, it was an itch to see if I could do it myself. Now, this was in an era without the availability of capital. There were no private equity firms back then. There were no VCs back then. You either borrowed money from the bank or you took a company public, not to cash out, but to have access to growth capital because there was no middle market for equity capital back then. So I had an itch. I think all entrepreneurs have some kind of itch. I had one to see if I could succeed, knowing that I could always move back to Tyler and practice law with my dad if I failed. The other one was very important to me and should be important to a lot of people, Justin, and that is I had a mentor. His name was Boone Pickens, and one of the
Wow.
more famous characters in the industry. I met Boone in 1984. My general counsel and partner was deeply involved in Republican politics. In 1984, Boone Pickens, then out of Amarillo before he later moved to Dallas, Boone was the state party chairman for then Governor Bill Clements, running for election in 1984. And so I got to know Boone, and I just fell in love with him. He was the greatest entrepreneur in the oil and gas industry. He'd just come off several years of being called a corporate raider, but effectively he was using the capital markets, going back to the Drexel Burnham days, and the ability to raise a lot of money in the debt markets. And Boone was a master at understanding opportunity in the business. Most people won't remember this or even know it, but when Mesa Petroleum out of Amarillo took a run at Gulf, and then later General American, and then later Phillips 66, the market cap of Mesa Petroleum was only $100 million. I sold Crestwood to Energy Transfer for $7.1 billion. So just to put it all into context, Boone had an ability to bring people around him. And for whatever reason, he became interested in me. And we had a lot of discussions over the next few years about how to grow a business. He appreciated my enthusiasm for growing an area of the business that didn't really exist, called gathering and marketing. Again, this was pre-deregulation of the industry. And so we worked together to create a lot of new ideas. We created a joint venture called Mesa Eastex Gas Marketers, which was the first marketing cooperative for producers that historically only had the ability to sell their gas to the pipeline at the wellhead. You never had the ability to shop your gas production around to get the highest price. You had to be a price taker at the wellhead. So I learned a lot of things from Boone. Boone taught me the lesson about using capital to build a company. And it was because of that close education that he gave me through discussions and joint venture deals that we worked on together that I then decided to IPO in 1987. It was a hot market. This was August of 87. For the older investors out there, they will remember what happened in October of 87.
The one-day
Black
crash.
Monday. Black Monday. The market dropped 500 points that day. I had taken Eastex Energy, that company that I started in 1981, public at $12 a share. By the end of that week of Black Monday, we were trading for $3 a share.
Oh, my.
And it was just like every other company out there. In a week's time, the market got scared and destroyed an extraordinary amount of equity value in it wasn't just oil and gas. It was every company out there that was publicly traded. But the point of the IPO was to access capital. Bank capital was getting very, very difficult to secure. We had tapped out on letters of credit, on expansion capital. We had growth opportunities, but had never really developed an equity partnerships on a private level that gave us a continuous inflow of equity capital. So the market was hot in the summer of 87. We hit the market just right. I'll never forget the road show. It was me and a banker, 18 cities in 25 days. Back then, they didn't have PowerPoint. There were slides. Slides were made at a film company, and you carried a carousel, Kodak carousel slide projector around with you, and they put a sheet up because they didn't even have screens for projectors like that. And so that was my road show for that IPO. I'll never forget it. One of the greatest experiences of my life, coming home from the East Coast after the end of that 25-day period and telling my wife, I'm not sure, but I think we're rich, honey. Well, we were for about 3 months until Black Monday hit on October 5th of that year.
That's an incredible story. Bob, my next question is what was the low point on your path to success? Was it October of 1987? Was that the lowest point, or were there any others that really stick out to you?
No, I very much enjoyed the first company, which I started from scratch and with a equity contribution of my original partner of $25,000. I bought him out years later for about $7 million, and then took the company public after that. The low point were the next 5 years after that, trying to compete with much larger companies like Enron, like Tenneco, like the Williams Company, like Duke. All of the major midstream players back then had access to so much more capital than we did. And so I committed a lot of mistakes. They were all learning experiences for me as a CEO and as an executive. I was selling stock to support a short term business, which is a major faux pas. You never sell long term equity to support short term profitability. And so I learned that lesson back in the late 80s, early 90s. It was a tough period. I remember a couple of times Shirley and I had to use our savings to make payroll just to keep the company going, which seems a
Wow.
little bizarre for a publicly traded company, but I didn't want to admit defeat. So those late 80s, early 90s, until we had some further really important deregulation of the industry, we had the development of the NYMEX, or New York Mercantile Natural Gas commodity contract, where you could actually buy production, store it in the ground, and hedge it going forward, and actually build in a spread between summer and winter differential. But all that took capital, and I didn't have access to capital. Nobody was giving equity capital to small NASDAQ stocks. We weren't a penny stock, but we were pretty darn small. So that was the low point. Justin and I made the decision by mid 90s to sell out to a much larger company with an A-rated balance sheet so I could have access to capital. And that led to the merger with the El Paso Corporation in 1995. So those 5 years before that were really tough, primarily because I wasn't experienced enough and I didn't have the right capital structure to be able to run the business that I was in. But we worked it out over time. We toughed through those tough years. We got the balance sheet in shape. We built our business. We built a reputation in the industry as being one of the largest independent marketing companies in the business. And ultimately, we became attractive to a regulated pipeline with an A-rated balance sheet. And that's what led to kind of the further success. But those 5 years before that merger with El Paso were pretty tough out there.
That's amazing. Bob, how would you say faith shaped your life and career? I know you mentioned a very strict Baptist background in Tyler growing up, but how did?
Yeah, actually, I was a Methodist, believe it or not.
Okay.
I think Tyler was about 70% Baptist. That's why they never allowed liquor to be sold there. Been a lifelong Methodist, and have enjoyed raising my 5 kids in the Methodist Church, all of them having been married in the Methodist Church. And so we were a typical Methodist family. We learned the importance of our blessings and how important it was to give back to the community. And so we've always been, as a family, very involved in charity work and given a lot of money and time and effort and prayers to the charities that we supported over the years. And so I think a faith-based background is not only important in raising family, but it's important in being a CEO of a company as well, because your employees are your family, and they depend on you to operate a company and build a culture that doesn't necessarily have to be faith-based, but it has to be honest and authentic. And so one of the great privileges of my life is to have, over the course of the last 30 years, well, 37 years since I did the first IPO, to be a leader of tens of thousands of employees, but use my faith-based approach to make sure that my employees understood how important they were to me, how important they were to our company, to our family, how important their families were to them, to make them effective and successful employees. And so I've really enjoyed being a leader of employees and employee families over the years. And I think it's my faith-based background that taught me how to do that, gave me context for why that was important as a CEO in any organization.
That's very neat. And Bob, I'd love to now dive in a little bit into Crestwood Equity Partners. I know you mentioned 1995, a moment with the El Paso transaction. What was kind of that bridge? What happened from 95 to the mid 2000s when you started Crestwood? What kind of led in those decade or so to what led you to start Crestwood?
Yeah, two really important jobs, essentially the same job, but with two different companies. So a little history on the business. The mid 90s, the regulated natural gas pipeline industry was going through consolidation, very similar to what the industry is experiencing today, largely on the upstream side, but obviously in the midstream side as well. My merger with Energy Transfer being a great example of consolidation in the midstream. We were going through pretty significant consolidation of all those interstate pipelines during that time period because of the impact of deregulation on natural gas. So interstate pipelines had to reinvent themselves. And one way they did that was to get involved in this new natural gas marketing business, which created a whole new non-regulated source of growth for these pipeline companies. And then ultimately, the companies began to consolidate themselves. One of the big consolidators was El Paso Corporation, and actually the acquisition of Eastex Energy in '95 was the first of all of the acquisitions that we did. I decided, instead of cashing out at then probably the ripe old age of late 30s, I decided to stay with El Paso and became president of their non-regulated business, and had a tremendous opportunity to grow the business in the non-regulated areas of gathering, processing, marketing, storage, infrastructure, power generation, international infrastructure development opportunities for the next 9 years. And we built a sizable business. When we merged in the summer of '95, market cap of El Paso was a little over $2 billion. At the peak, it was $66 billion. All of that through acquisitions of major other companies, culminating with the acquisition of the Coastal Corporation, Oscar Weitzold Corporation, in 2001. Almost immediately after that, Enron went bankrupt in December of 2001, and that changed the landscape for everybody. We had all been on a very aggressive growth, spending a lot of growth capital, raising a lot of money in the capital markets, which had been very friendly towards energy at that point in time, traditional energy, long before renewables. And so the combination of trying to integrate the coastal organization at the time in which Enron was going bankrupt and the industry was literally turned upside down, particularly from a financial market standpoint, was too much for us to handle. So I worked with our board to come up with a plan to carve out our midstream business, which had been the fastest growing business inside the El Paso portfolio, carve it out of El Paso and merge it with a company then called Enterprise Products Partners. It was a roughly $10 billion merger between those two companies.
Wow.
But it provided about $4 billion of capital that kept El Paso out of bankruptcy in the aftermath of Enron. El Paso then kind of struggled along for years and ultimately wound up selling to Kinder Morgan. And it's now part of the Kinder Morgan organization, which is a great company, largest natural gas pipeline company in the world, for that matter, certainly in North America. And so that is what happened to El Paso. I moved on to Enterprise Products and spent the next 4 years, which was invaluable for me personally to learn the ins and outs of the natural gas liquids business, from processing in the field all the way through product fractionation at Mont Belvieu, and then ultimately exports of ethane, propane, butane, isobutane, all the major products to the petrochemical industry. I had not been exposed to that area of the business, but that
Wow.
4 year period was incredibly important to set me up then for setting up Crestwood initially in 2008 with a set of private equity partners. I made a critical mistake, an error in judgment. I brought in 3 private equity partners to give me $1 billion equity capital commitment. Blackstone, a company called GSO, now a part of Blackstone, but then a separate independent private equity firm. And then Kane Anderson, a private equity firm from California. And I literally had too many cooks in the kitchen. So I spent 2 years with those 3 private equity firms, despite the fact that they had huge equity commitments to Crestwood One. We were at a point in time in which there was, again, a commercial transition going on. It was 07, 08, 09, the beginning of the shale industry.
Yeah.
And the big shale plays then were the Barnett Shale in Dallas, Fort Worth. Nobody had ever heard of the Haynesville or the Bakken up in the Williston or the Eagle Ford in South Texas. And certainly there was no drilling activity going on in the Permian Basin, which is now the largest basin that we have. But this was at the very beginning. So we had a very challenging first couple of years, and I learned the importance of being on the same page with your equity capital or your investors. And so that was a valuable lesson for me to learn. I terminated that partnership at the end of 2009, formed a new partnership with a private equity firm called First Reserve out of Connecticut. A much smaller equity commitment initially, $500 million. But I had a single partner, we had a single strategy, and we were all on the same page. And we started having success almost immediately with the first acquisition of Quicksilver Gas Services, gathering and processing company in the Barnett Shale in the DFW area. And that was the beginning of what later became Crestwood. 13 years later, we sold to Energy Transfer for a little over $7 billion. So I've been through all the different cycles in the business relative to, financial capital markets, how you get money, where you get money, how you structure the equity investments, who your partners are, why they work, why they don't work, publicly traded, private. I've kind of done it all in a 47-year career, and I really appreciate all those experiences. But ultimately, my greatest success was this last one as Crestwood, and it was a culmination of all those experiences that I had, Justin, going all the way back to the startup of East Texas Energy in 1980 and graduating from law school and understanding contracts and the importance of compliance and partnerships and relationships and how important credibility is in an industry.
That's incredible. 2 things stick out to me. You had some pretty incredible moments building businesses during 2 of the most noteworthy market crashes since World War II. So pretty incredible that you IPO'd just months before the one-day crash in October of 1987. And then a lot of the early formation of Crestwood was really during the great financial recession during 2008, 2009. Was there ever a point in time where you thought that, hey, Crestwood may not be able to get off the ground?
Yeah, but it was more commercial than it was financial. The financial markets have been largely good for Crestwood since the beginning. And you just look at the interest rate. I mean, we lived in a 2 to 3% world forever. I can't imagine having a better cost of capital to start a company with than during that time period from 2010 till just last year. I mean, the fact that you can borrow money at 2 to 3%, 4% on your revolver. You can go sell long-term debt for 5% as a double B plus company, non-investment grade. I mean, that was a critical part of our success, having access and pretty unfettered access to low-cost capital. But the big changes for us, the low points, the big challenges were more commercial and really transitional in this business. The shift from natural gas in the early thousands, when natural gas was trading at over $5 an MCF, almost overnight in 2011, declining to under $2, that sent shockwaves through the industry. Then we pivoted to liquids and oil. In 2014, oil was over $100 a barrel. Tremendous amount of oil-based activity. As investors, we make long-term investments for oil infrastructure based upon $100 pricing. And by February of 16, oil goes to $25 a barrel and the industry shuts down. Those two big commodity-based events created huge challenges for our industry because this is not a short-term industry. This is a long-term infrastructure industry. And so we have to make infrastructure investment decisions based on 10, 15, 20-year timelines. The last one, and then I'll turn it back over to you. I know we're running short on time, is ESG in 2018. One of the biggest challenges our industry has ever faced, a bigger challenge than financial market dislocation or much stronger regulatory oversight during the Obama years and the Biden years. And that was the emergence of ESG as a core principle of operating the oil and gas industry. It started in about 2018. We got way ahead of the rest of our midstream sector and developed an ESG program very early on. Was multifaceted. I brought in an expert from a regulated pipeline who had developed their Canadian-based ESG program. She did a fantastic job in developing for little bitty Crestwood a full diversified ESG program focusing on environmental emissions long before it was required or it became cool, focusing on social and community involvement. We had a number of tribal and indigenous stakeholders around our assets. We became one of the leaders in the industry in developing indigenous programs to give back to the community. I remember going to North Dakota in 2014 and meeting the chief of the tribe initially and saying, I want to build a $2 million school here on the reservation for your children who don't get to go to school. And that started and developed a great relationship that we had with the Ameche tribe for a number of years. So having ESG front and center was important. In the governance area, we were the first master limited partnership to convert our golden share control to a publicly elected, fully independent board. And so we were aggressively pursuing in all ESG categories programs and initiatives that would make us more attractive to non-oil and gas generalist investors. And I think that's what allowed Crestwood to stay active and continue to raise capital in the last 5 years or so from 2015 on, where we spent not only over $15 billion in acquisitions, but $3 to $4 billion in organic investment capital. We had the capital and the access to the capital markets because we made the decision in 2017 and 18 to be a leader in ESG. It was a big challenge for the industry, I'm proud of the way the industry has responded to that. And I think we're a much better industry because of that. Now, as we see, the industry has gotten in front of that issue. And I think it's not as big an issue with investors as it was. And people now want to get back into oil and gas investing. And I think that's great for the industry.
Absolutely. And it's pretty incredible to think about the changes that happened in oil and gas from 2015 to 2020. Bob, I would love to focus a little bit about the transaction. So Energy Transfer buys Crestwood Equity Partners for 7.1 billion. What were you feeling before and during that deal closing?
Well, I was very fortunate. I had a great young management team, and we were all on the same page from day one. I had approaching age 70 this year. I had already announced to the board that I was prepared to put a succession plan in place. I was going to move to executive chair this year in 2024. I had already identified my great young successor. Robert Halpin had been my CFO for years. I had promoted him to president. He was beginning to take over the day-to-day operations of the company. I was focusing more on strategy. But Robert and I and my young leadership team were all on the same page. We do this for our investors. Our job is to create value for our investors. And so as a course of our annual governance program, we met annually with our board to update them on market conditions, the strategies, where we could go to make either organic investments or acquisitions, M&A activity, divestitures, balancing the balance sheet, improving our credit rating, improving our ESG scores. And ultimately, we got to the point in 2022, post COVID, where we recognized that industry consolidation in the midstream was inevitable. And we felt like it was too long a putt to get to at least $10 billion, if not 15 or $20 billion in enterprise value, to be a relevant major player in the business, to be a buyer in consolidation as opposed to a seller. So early on in 22, even though we had a $400 or $500 million per year organic investment program going, which we had capitalized properly, and even though our stock was highly coveted in the small cap market, or the SMID market, small to mid cap market, even though our management team was widely recognized as one of the best management teams out there in 2022, Institutional Investor recognized Crestwood as the number one energy management team. I got best CEO. Robert got best CFO. We had best investor relations program. We had best ESG program. So we were widely acknowledged as one of the real players, despite the fact we were a SMID. We always knew that when consolidation came, we were going to do the best thing for our investors, for our shareholders. As a master limited partnership, publicly traded partnership with K1s, there was a limited universe of buyers for that stock. And from a consolidation perspective, there were only less than 10 major MLPs left that could actually acquire a company the size of Crestwood. We had almost gotten too big to get bought out. Wow. We weren't big enough to be relevant from a commercial standpoint, but almost too big to get bought out from a financial standpoint. So in early 23, an old friend of mine, an investment banker, came by for our annual year-end discussion, and over martinis, he said, "Where are you going with this?" And I said, I think 23, 24 will be a consolidation year for this industry. And while I'm never going to put a for sale sign on this company, it's so demoralizing to employees, customers, stakeholders, landowners, and particularly investors, I would, if the right opportunity came along, listen if someone wanted to acquire the company. And it was not only at a fair market price, but I would be giving my investors a better security than Crestwood is. Well, months later, April of that year, he walked in and said, I just talked to Energy Transfer and they would be interested in talking to you. So that led to a series of management team discussions, and the rest was kind of history. We had due diligence throughout May and June. I went to my board in early August of that year, and we had approved the transaction that we ultimately announced on August 16th and closed on November 3rd. And I think the thing I'm most proud of is that the Energy Transfer and Crestwood stocks both traded up immediately upon the announcement.
Wow.
Energy Transfers up about 25% since that acquisition. And we had almost 100% approval of our shareholders, 95% approval at the annual unit holder meeting to approve the transaction. It wasn't even close. We had 95% approval, and we had the blessing of both ISS and Glass Lewis, who are two shareholder-friendly organizations, rating agencies that don't often give unanimous approval to a transaction. So it told me we did a fair deal, we did a timely deal, and we're giving our investors at Crestwood an opportunity to grow their investment in a much more diversified portfolio over a period of time in which this industry is going to be volatile, whether it's due to financial markets, commodities, geopolitical, or the presidential election. I'm glad that our investors own a significant interest in a company that has $115, $120 billion in assets versus the size company that we were. So really proud of how all that worked out.
That's incredible. What an incredible story, and what, just really an unbelievable, even after a 47-year career, to be able to have that type of exit is just tremendous. I'd love to finish up as we wrap up here with two quick questions. Bob, if you were talking to a 30-year-old in oil and gas today, and that 30-year-old is, thinking through how they want to build their oil and gas career, what advice would you have?
Well, two things come to mind, Justin. One is I have a totally different point of view today than I did back in 2018, pre-ESG. I think the industry has a tremendous future ahead of it. I know, technically speaking, the resources that we have in North America are incredible. 50, 75, 100 years of oil and gas resources that can be produced at a much higher level, assuming we have the right administration and the right regulatory approach to energy, and how important energy is geopolitically to keeping America safe and making America continue to lead, allowing America to continue to lead the world towards freedom and democracy. It is our job in this industry to be able to produce reliable, efficient, environmentally sound, traditional fossil fuels to fuel the world economy. I'm not sure I would have said that in 17, 18 pre-ESG, but I say that today. I am totally convinced that there's easily another 25, 30 years in the industry as we know it today. And there's a lot of debate about peak oil and all that sort of stuff. In my lifetime, demand for oil and natural gas will continue to grow incrementally every year. Not in the US, as we're more quickly than the rest of the world making this transition to renewables and non-traditional sources. So that's my overview. Big change, very positive and optimistic about the future. The second area is about financial capital, and I've mentioned the availability and access to low-cost capitals a number of times throughout this last hour.
Yep.
And every stop in the road for me, capital was important. And actually, many times, availability and access to capital made me make a choice that I might not have made if I'd stayed private and had access to unlimited low-cost capital. I think that the capital markets have made a major change towards oil and gas, and I'm seeing it in a number of different areas. And I'm very pleased with the way that the capital markets are setting up for oil and gas over the next 10 to 15 years. And that's about as far as you can see.
Yep.
But the difference this time is cost of capital 6.5%, 7%. And companies, the smaller companies have a weighted average cost of capital of more like 8 to 9%. The larger companies obviously have a much lower cost of capital, between 5 and 6%. So as an industry, we're going to have to learn how to live successfully in an environment with a much higher weighted average cost of capital. And I don't think that's ever going to change. We're not going to go back to the days of 2 to 3% revolvers and 5% long-term debt. We're just not. For the investment grade companies, yes, on the margin, they can continue to raise large amounts of capital at reasonably low prices. But for the rest of us out there, young people that want to go start a business, you have to understand that the challenge is greater today to make investments with returns not only in the mid-teens, but the mid to high teens, because of the much higher weighted average cost of capital, equity, and debt that you're now going to have to access to be successful in your career. The good news is capital is available.
Yes.
But it's not going to be in traditional sources necessarily like the public equity markets. A lot of it's going to be driven by private equity. A lot of it's going to be driven by private credit portfolios that are being developed out there. And so as a user, you're going to have access to the capital. It's just going to be more expensive, which means your investments have to give you greater returns than they historically did. As an investor, one of the things that we're looking at in our family is private credit and the opportunity to provide investment capital to the industry over time and be a real part of the long-term solution for oil and gas. It is a capital-intensive business, and you have to have access to capital to be able to succeed in this business. That's one reason why we're seeing consolidation, because there is going to be a limited amount of capital available for companies, and it's going to be more expensive than it's ever been before. So those are the two things. I think they're both optimistic. The long-term point of view, traditional fossil fuels are going to be here at least for my lifetime. And for most of these young people coming out of college, I wouldn't hesitate for somebody coming out of A&M or Texas or LSU or Oklahoma with a petroleum engineering degree or a geology degree or a petroleum land management degree. This industry is going to be here for a long time, and they should have access to more than enough capital to continue to grow and develop the industry and take advantage of this incredible wave of technology, largely coming from the services industry, that has driven the success of the industry over the last 15 years and will continue to do that.
Absolutely. I think the future is bright for oil and gas. And to your point, private credit is going to play a massive role in oil and gas, but in every industry. And so it will be interesting to watch. Very last question for you, Bob. Success can mean lots of different things to different people. At this point in your life, how do you define success?
The thing that I'm most proud of are all of the young people that I had an opportunity to mentor over the last 47 years. And I've been blessed by God to touch a lot of lives, not just the employees, but the customers, the service providers, the landowners, the ranchers, the tribes, and have a positive impact on that. My success is having built a good reputation, which I can't stress enough the importance of maintaining a good, credible reputation in this industry. because it is a long-term industry. But the opportunity to give back to the communities in the areas where we've operated and our employees have lived has defined my success as a person. Yeah, the money comes with it, and that's great. But I don't think anybody should do this for the money. I think you should do it for the opportunity to play an important role in a vital American industry that is so important to the success of the American economy and the global economy, and to be an important part of that. And I think there's a lot of personal satisfaction that comes to me from just knowing that I created a lot of companies that created a lot of value for a lot of investors. But more importantly, I signed a lot of paychecks over the years, and I paid a lot of wages and paid a lot of taxes to local, state, and federal governments. And I think that's what I'm most proud of.
That's incredible. Well, Bob, thank you so much for joining us. And to all of our listeners out there, don't forget to subscribe. We'd love to hear any questions or ideas for future episodes. Podcast at brownleewealthmanagement.com. Thanks for listening.